if you didn't realize it before, we face a mess of troubles. And when you ramp from 10 trillion in debt 15 years ago to $34 trillion in debt almost right now, I mean, we're 33.5 trillion and we're approaching 34 trillion, it's going to create a whole lot of problems. And this is a massive change from what we've seen in the past. For example, let's go back to the interest rate chart here. We were at 20% interest rates when I graduated from college, right there in 1980, and then it got to 0% just a year and a half ago, and now we're approaching back to 5%. These are major, major shifts in the economy. That's why we said things have changed. So if there's an economic crisis ahead, what's it going to look like? I'm going to give you 10 things that you need to watch out for. When we go through these 10 things, then we'll come up with an action plan. How do you protect yourself? How do we protect our nation? So the 10 things, we'll walk through them one at a time. 10 things to watch out for. Number one, a slowing economy that will not eliminate inflation. Now, why do I say that? Well, because the economy, traditionally, if we slow the economy, it means inflation goes down. That was true for 40 years. I graduated in 1983 from college, and for 40 years, we've seen every time that the economy slows, we see interest rates go down and we see inflation go down. That's not going to happen going forward. Why? Because we let the genie out of the inflation bottle. People now are demanding, I need higher wages. You see it when you walk by restaurants and they're offering $15, $16 an hour. You see it when the auto workers are demanding and striking. People want more money. And we also see the cost of goods and services go up. We also see the fact that the Federal Reserve is losing a little bit of control of the money supply. We have a new higher threshold. Prices are not going to go down. If you saw gas at $1 a gallon, you're not going to see that again. You're not going to see maybe $2, maybe $3. They'll bounce around. But the new inflation, I'm telling you, is here to stay. And that means that stock market gains are no longer automatic. And let's look at the stock market chart here. Here's a 100-year chart on the Dow Jones Industrial Average. In that 100-year chart, it really bounced around, and you can see it bouncing around until 1982, right there. And from 1982 to the present, it has been massively up. This is a very unusual period for stock prices. Sure, we've had recessions, and sure, we had the COVID drop, but overall, the trend has been pretty high, pretty much higher. That's a 100-year chart on the Dow Jones Industrial Average. It's not always like that. If you took a 100-year chart at any one of these points going back, it wouldn't be that straight up as we've seen for the last 40 years. So watch out, stock market gains are no longer going to be automatic. And we're going to see multiple fiscal cliffs. We just saw one where the Speaker of the House was ousted because there's a fiscal cliff. Are we going to close the government and all that? We're going to see those on an increasing basis going forward. So the first trend is slowing economy. Second, without lower inflation. The second trend, stock market gains that are no longer automatic. The third trend is multiple fiscal cliffs. Now here's the fourth trend, the housing dilemma. On the housing dilemma, we got to watch out. Here are 30-year fixed rate mortgage interest rates. Again, from 1982 until recently, we saw interest rates falling sharply. I mean, we were almost at 20% fixed mortgage rates. We got down to 3%. Did you refinance your house at 3%? If you did, you did great. Here's the problem, though. When interest rates have spiked sharply higher, and we haven't seen spikes like that since the late 1970s. That's the last time we saw this big jump. Now people are paying over 7% for 30-year mortgages. The problem is that we have an inventory issue. Anyone who was financing their mortgage at 3% doesn't want to buy a new house now. Oh, I can't afford to get out of the house I'm in to get into a new house. Why? Because I'd give up my 3% interest. We also see demand right now decreasing because the rates are going higher. So the inventory is going down and the demand is going down, and so the prices are staying high. And rents are very high as well. All of this contributes to inflation. Higher rents means that the mortgage market, the housing market, is going to move in fits and starts. So if you're looking to buy a home, it's a scary time. You don't want to sell your home, so you're staying in your home. which has created what I've called as the housing dilemma. That housing dilemma, it means that people aren't going to be saving money in their houses like they have in the past. Young people are renting more. You know what the World Economic Forum said? You'll own nothing by the year 2030 and you'll be happy. This is maybe one of those reasons why.